All right, welcome. Today, we're diving into a theory that might just flip everything you think you know about the financial markets on its head. What if all that price movement you're staring at isn't random at all? What if it's actually a game, a carefully constructed game? Let's get into it.
So let me ask you this. You ever put on a trade, you set your stop loss just where you're supposed to, and then you watch the price just spike down, tag you out to the exact tick, and then, boom, it reverses and rockets in the direction you thought it would go? It is the worst feeling, right? Well, according to the source material we're looking at today, that might not be bad luck.
And that feeling leads right to the big idea here, the fundamental shift in thinking. Most people see the market as pure chaos, millions of people making random decisions. But this method, it says, no way. The market isn't chaos. It's engineered. It's a system that's been deliberately built for a purpose.
To really get this, you got to shift how you look at things. You have to stop seeing it as a chart and start seeing it as a game. A game with very specific players, very specific rules, and a deck that is absolutely stacked in favor of the people with all the money. Just look at this number, $4 trillion. That's the kind of money that moves through the Forex market every single day. But here's the thing, that colossal number isn't coming from retail traders like us. The source for this explainer is clear. The huge majority of this volume comes from massive institutions. They're the ones with the firepower to actually move price. So what does that mean? It means price isn't really moved by some vague market sentiment or the emotions of the crowd. According to this theory, price moves because of cold, hard, logical decisions made by these big players who are in control.
Okay, so who's pulling the strings here? Who are these big players? Well, let's pull back the curtain and meet the main character in this whole story, the entity known simply as the market maker. Now, let's be super clear. The market maker isn't one guy in a dark room somewhere. It's a concept. It's the combined force of the big banks and financial institutions. Think of it as the house in a casino. They have access to insane amounts of trading volume, which gives them the power to steer the market. And their goal? It's simple, to make money.
So how do they make that money? Well, the source material breaks down their game plan into three main goals. First, get you to take a position, usually the wrong one. Second, create flashes of panic and fear to make you act emotionally. And third, and this is the big one, hunt down those stops and clear the board, forcing you out of your trade at a loss, which, of course, becomes their profit.
Okay, so if this is all a game, then there must be a playbook, right? Well, according to this theory, there is. And this is where it gets really interesting. The theory lays out this predictable daily cycle that is designed to do exactly what we just talked about.
It's like a simple three-act play that happens over and over again. Act 1 is accumulation, where they're quietly building up their positions. Act 2 is the stop hunt, the big, dramatic, false move. And finally, Act 3 is the true trend, the real move they were planning all along.
So, Phase 1, accumulation. This usually happens during the Asian trading session when things are kind of sleepy and the market is just chopping back and forth in a tight little box. It looks boring, but under the surface, the market maker is quietly building up orders, getting ready for the fireworks. And then, bam! Phase 2 hits, the stop hunt. This often happens right around the London Open when volatility picks up. They intentionally shove the price outside of that quiet range, maybe 25, maybe 50 pips. And this move has two jobs. One, to hit all the stop losses from people trading inside the range, and two, to trick breakout traders into jumping on what they think is a new trend. And here's a little pro tip from the source material. That stop hunt, it rarely happens in one clean shot. It often comes in 3 little pushes, or 3 candles. Why? It's a mind game, right? It's designed to make the false move look legitimate, to make it look strong, and to suck in as many people as possible in the wrong direction. So once they've lured enough people into the trap, snap, it closes. The price violently reverses and starts a much slower, steadier move in the complete opposite direction. This, according to the theory, is the true trend. This is the real move they intended to make all along and the one they're going to profit from.
All right, so we know the cycle, we know the playbook, but how do you actually see it on a chart? How do you spot these traps as they're happening? Well, the theory says the market maker leaves behind a few visual clues, a few signatures.
And one of the biggest tells they supposedly leave behind is a classic chart pattern, the M and the W formations. The source material calls these out specifically as fantastic reversal patterns. They are literally the picture of the trap being set.
So let's walk through this M formation. Imagine you're at a market top.
Price makes a strong push up, forming the first peak of the M. This looks super bullish, right? It ropes in all the breakout traders who are now buying, thinking this thing is going to the moon.
And here's the kicker. This is where the trap gets set. The price pulls back a bit and then tries for another high, but it fails. It forms a second, lower peak. Now, anyone who bought on that first push is trapped. They're underwater. And as the price rolls over from that second peak, the real move, the downward reversal, begins. Game over.
Okay, so what do you do with all this? If you can start to see these cycles and patterns, how does it actually change the way you trade? Well, the theory says it's not about a new indicator, it's about a whole new mindset.
The number one rule, the absolute first thing to get, is this. You are not going to beat them at their own game. A retail trader, you and me, we just don't have the capital to fight these massive institutions. If you try to fight the market maker, you will lose.
So, if you can't beat them, you join them. Or, more accurately, you learn to piggyback on their move. The whole idea is to learn to see their traps, to recognize the stop hunt for what it is, and then you wait. And you place your trade in the direction of their real intended move, the true trend. Look, at the end of the day, this whole thing is about a massive mental shift. You have to stop seeing the market as this chaotic, random mess. You start seeing it as a structured game. You're not just looking for a trend anymore. You're looking for the setup. You're looking for the trap.
Which brings us to the one question you should ask yourself every time you look at a chart from now on. Are you just blindly following the obvious trend that everyone else sees? Or are you learning to see the trap before it springs? Answering that one question could change everything.